G'day and welcome to this week's client question. Yesterday I had a good question from a client of mine who is on the process to transitioning into retirement, probably 5-7 years away, but he was listening to the ABC radio where someone was talking about when you get to retirement and if your shares have done quite well over the time, it's an opportunity to sell all those shares and lock in the gain into cash, and then make that money very secure. And he wanted to know what my thoughts were about that. Now, in brief, I think we've got to assess people's timeframes, and for these clients, one is 5 years older than the other, so if he gets to 65 and his shares have done quite well for him over the time, at this point in time, I'm sure they'll do significantly better over the next 7 years. But get to 65 when he decides to retire. The idea of selling them down at age 65 when his partner, his wife, is only age 60, and more than likely, she will make it, or one of them will make it through to mid-90s. They're still 35-year investors. So by retiring your money and bringing that back to cash, at age 60, because now you're officially retired, is a significant risk over the long term to become ultra conservative at that point in time, given that there's still 35 years remaining of retirement. And the other issue that I mentioned to him, that when you do get to retirement, you've got your superannuation assets full of your shares, Aussie and international and other diversified assets, that when you get to 65 or retirement, whatever age that is for people, it's not a wholesale sell down in one hit. We're not selling down straight away just because we're at 65 and moving to cash. We generally go from the accumulation side of superannuation and we roll that over to a pension. And those pensions are generally pay out a monthly amount, which essentially means we've got gradual sell downs over a full retirement over 20, 30, up to 40 years. So there's no one big hit where you sell everything down because we've become conservative. Obviously, timing markets is particularly difficult in the short term. We have no idea what's going to happen. But if these pensions are paying out bit by bit, slowly over time, I see absolutely no need for us to lock in capital gains on assets that have been fantastic for us up to retirement. There's absolutely no reason that these businesses can't be fantastic and continue to grow for the next 35 years. Hope that's a bit of a help. Thank you for listening. Please subscribe to the channel if you haven't done so. For those that have, thank you for supporting us. We really appreciate it. And we'll see you at the next video. Catch you.